Hello and welcome to Financial Education for the Nation. My name is Warren Shute and I'm here today. I'm going to talk to you about workplace pensions. The workplace pension is the pension scheme that's been put in place by your employer. So if you're an employee, this affects you and is designed to ensure that they meet their obligations under the legislation. So there's three things we need to look at. First thing is the type of pension scheme. The second thing is the type of worker that you're categorized at. There's three different types of worker. And the third thing is the contribution basis. How are they paying into your pension scheme? Then when I cover those three things, I want to touch on the self-employed. So if you're self-employed, please don't switch off. It's important that you're listening to do that. And also about contributing more. I'm going to keep flicking down because my notes are down here to keep me on track, staying focused. Okay, so firstly, the type of pension scheme. If you work for an employer and they've always had a pension scheme in place, that pension scheme may be qualifying. And that basically means it meets the minimum standards required set down by the legislation, so they don't need to do anything different. So this could be, if you're in a very fortunate position, you're in a defined benefit pension scheme or a final salary pension scheme or a career average scheme. They're actually all the same thing with just different names. Then that most likely or inevitably is going to meet the legislation minimum requirements. If you have a group personal pension scheme put in place or a defined contribution scheme, that means you pay money in, your employer pays money in, and that meets the minimum requirements set down by the legislation, then tick, your employer's done that already, they don't need to do anything. But if you work for an employer that never had a scheme in place, they needed to put in place this auto-enrollment scheme. This is a scheme where you are automatically enrolled into the scheme without you completing any forms after their waiting or deferred period, which can be up to 3 months. It's those schemes that have been put in place specifically for the workplace pension. Now, with this, with all the schemes, actually, not just with that one, there are three categorizations of employees. And those categorizations generally are around your age and how much you earn. So the first categorization, which is known as the eligible job holder or type 1, are anyone from age 22 to state retirement age. So if you're 22 years old between state retirement age and you earn over £10,000 a year, you are defined as an eligible job holder or a type 1 and you're automatically enrolled in the scheme. So you go and start work for the employer, you're automatically enrolled in the scheme straight away or after their waiting period, their deferred period. And you then would have to opt out or unenroll if you didn't want to be a member of the scheme. Now, please don't do that. There has to be a real special reason for you to opting out of the scheme. And you saying to yourself, actually, I can't afford this, or I'm not going to need it, or it's not a very good scheme, or I can do better myself, is not a good enough reason, I promise you. Okay, so if you are automatically enrolled in your pension scheme, stay in it. That means you're an eligible job holder. Now, the second category of worker is a non-eligible job holder or a type 2. And this is people who don't meet that first criteria, but they earn over £6,136,000 a year. Okay, odd amount, £6,136,000 a year. That's the lower earnings threshold where national insurance qualifications sort of kick in and things. Now, if you are a type 2 worker, so a non-eligible employee, it means you can ask to be enrolled in the scheme and your employer must contribute. So you're not automatically enrolled, but you can ask to be enrolled. And if you do so, your employer must contribute. Now, have a little think who this might apply to. How about people starting the workplace? So they're below age 22. Okay, you're going in, maybe it's your first job. You join the employer. You're earning over roughly £500 a month. Tick, you qualify as a non-eligible worker, but you're not automatically enrolled because you either don't earn over £10,000 a year or you're not over 22 years of age or 22 years or older. So you can ask your employer, please, may I automatically or may I join the pension scheme? And once you have joined, they must contribute as well. Then there is a third category of employee, and that third category is called an entitled worker, also classed as type 2. I don't know why they've added this type 2 on, and I don't know why they've called it an entitled worker, because basically it should be called an unentitled worker. You're not really entitled to anything as an entitled worker, so you're not automatically enrolled, and there's nothing happening for you, unfortunately. And this is for people who earn less than the £6,000, £6,136 a year. But you still can go to your employer and say, I would like to join, please. And they must allow you to join. However, they don't have to, by legislation, contribute. So just you're contributing. You might think, well, what's the point? I must do it my own pension scheme. If they're not going to contribute, I'll do my own. No. First of all, you do it on your own. You have to go out and research the marketplace. You just want to buy the first pension that you come across. You want to make sure you get an appropriate pension. Actually, your employer's already done that for everybody else. And economies of scale mean that your employer scheme is likely, this isn't for certain, you need to check it out yourself, but likely is going to be a lower charged arrangement than the type of arrangement you can arrange for yourself. Okay, so join it. Or certainly, should I say, inquire and learn more. Although your employer doesn't have to contribute to the scheme, will they? They might say, actually, you've taken the initiative to join, we're going to contribute on your behalf as well. And that, my folks, is free money. That is the nest, that is the quan, as they said in Jerry Maguire. That is what you want, the free money, the contribution your employer is going to pay in. So even if you earn less than the £6,136, you're classified as an entitled worker, you can still join the pension scheme. And I encourage you to investigate this more, and it's likely that you should do this. And hopefully, if your employer is able to, they will also contribute as well. I was going to say then, if your employer is a good employer, but that's a bit cheeky, if I'm honest, because there might be situations where they can't afford to. They're taking a punt on taking this person on, or they're helping you out a little bit for doing that. Or it's just not available through the software that they use to actually contribute for you. So if they don't contribute, don't bust your boss. They might not able to in some circumstances, but certainly the scheme is likely to be researched. Okay, we'd hope so, and it's likely to be lower charged than you can arrange yourself, and it saves you the legwork, and it's there. And what I've learned from individuals is deductions from your payslip before you get paid are far easier than you paying for it yourself. So if you were going to get paid, for example, £500 a month, and from that £500 a month, you've then got to go and pay in, say, £25, £30 or so into a pension scheme yourself, well, that's a bit harder than you just receiving £470 a month and it all being taken cared for on your behalf. So deductions at source, as they're termed, are much easier. So even though you're not automatically enrolled, like the eligible job holders, the people 22 years old, up to state retirement age, earning £10,000 a year or more, and getting getting contributions added to it themselves, or a non-eligible job holder. So this is the type 2. This is the people earning above £6,000 but don't meet the age criteria of the first set, where they also get contributions added. Even the entitled workers should seriously consider asking their employer that they would like to join and go into the scheme. Okay, that's the worker type. The next one is the contribution levels. The contribution levels are basically based on how your employer has set the scheme up. There are 4 types. The first one is the basic qualifying earnings. This is the legislation minimum. This basically says that there are no contributions made on the first £6,136, and the contributions are based on the percentage of earnings between that figure and £50,000. So, for example, if you earned £5,000 a year, there would be no contributions made on your behalf because there's nothing made on the first £6,136. Okay, if you earned £60,000 a year, your contributions were only based on your income between £6,136 and £50,000. Nothing is made on that extra £10,000 at the top. Okay, so it's just based on that band of earnings, and the contribution percentages are 3% from your employer, 5% from you. But remember, you get the tax relief on yours, so it's only really cost you about 4%. So 3% from your employer, 5% from you, but that's only costing you about 4%. That's the legislation minimum. Anyone who's in the pension scheme will at least be getting that. A lot of employers find that banded earnings, that qualifying earnings, is a little bit complicated to explain. We certainly do at Lexington. We're a financial planning firm, so we just go for basic salary. We just put the contribution on base salary, and most of you listening will understand what I mean by basic salary. It's just what you earn. It's just your basic salary. It doesn't include overtime or bonuses or anything. Your basic salary, and then the contribution rate for a basic salary, which is the second option, is 3% for the employer again, but 5% from the employee. So slightly more for some reason. Oh, sorry, it's the same, isn't it? It's slightly more for the employer, 4% for the employer, 5% for the employee. And remember, you get the tax relief on that, so it's only really going to cost you 4%. But it's a lot easier to understand. That's the second option of the four. And then the third option is this thing called pensionable salary. Now, pensionable salary can be defined by your employer as long as the definition makes up the bulk of the overall payroll, 85% of it. So as long as your bulk of your income is for basic salary, then they can use this definition rather than basic salary. And the difference between the two, sounds a little complicated, is the percentages that they pay in. So for pensionable salary, the employer only pays 3%, whereas you pay 5% still. So the 5% is consistent across the board here. And then the fourth definition, okay, the last one, is total income. And as the name says on the tin, total income will include overtime, bonuses, everything else. Very, very, very few employers have actually opted for that option for obvious reasons. So as you can see, there's a lot more going on under the lid, as it were. You've got the different categories of worker and where you fall. There's 3 of those. And then you've got the different contribution tiers or bases. And your employer can actually choose a different basis for different categories of worker. So say, for example, you've got managerial staff, they can be one section. Your administration staff can be under a second section. Sometimes they do that. Sometimes they feel the need or benefit of doing that. Other times that is just a little element of complexity that's not necessary. And they just go for the same across the board. Anyway, whatever they decided, what's important is that you know what type of worker you are. Okay, so whether you've been automatically enrolled, and if you're not automatically enrolled, you've actually gone to them and said, I would like to join. And if you'd like to join, whether they're going to automatically pay in or not, depends if you earn over that £6,136 a year. Okay, it's about £500 a month. Just so you know, for clarity, it's based on your pay reference period. Complicated way of saying it's based on your pay. Okay, so it's what you earn in that period. So if you get paid monthly, most of you listening will be paid monthly. If you're paid monthly, it's basically 1/12 of that amount. As soon as you hit 1/12 of that amount, then it triggers the auto enrollment legislation. So hopefully that's given you good insight to the workplace pension. If you don't get statements through annually, a lot of these schemes are online. Make sure you log in, you know your login details, keep it organized. Step 2 of the money plan is get financially well organized. And part of that journey is to make sure you know how to access this information. Have a look at how it's performing. Once a year is sufficient. Don't expect it to rise every year, just expect it to rise over time. You really should be looking at the actual fund itself. Ideally, it's in a globally invested fund and it's in an index or a passive type arrangement. I would expect it to be to keep the charges down. But it's good for you to have insight on this. And remember, feed me some questions. If you get some questions on your workplace pension, you're not sure about it, message me and I'll address it generally to everyone so they can all get information from it so you can learn. Okay, so what we've spoken about there, just the 4 different things, are the minimums, or that's what your employer's paying. Remember, you can pay in more than your minimum. So whether your employer's paying in 5%, 3%, or whatever it might be, 10%, you can contribute 100% of what you earn into a pension scheme in a financial tax year. Capped at £40,000, okay? Now that contribution is based on yours and your employer's contributions, so it's total contributions, equals 100% of what you earn capped at £40,000 unless you're affected by this complex thing called the tapered annual allowance, and that's for people who earn more than £110,000 a year. So if that affects you, let me know. I'll do a separate video on that another time. But for the bulk of people watching this, you're capped at 100% you earn or £40,000. Now, obviously, if you put in 100% of what you earn, you have no money left to pay all your bills and have fun and enjoy yourself. So the reality is most people are not going to do that. But the reason I'm telling you this is you can obviously do a lot more than your basic employer contribution. And I encourage you, I plead with you to try and do at least 12.5%. So set aside the first working hour of a working day, an 8-hour day, first working hour of an 8-hour day, pay yourself the first working hour, 12.5% of your income. Now, some of you will listen to say, that's just not possible, Warren. I've got all these other bills. It's just not a reality. I hear you, I'm with you, but I bet you can pay some more. And some more is going to be better than nothing in addition. So start increasing it. And maybe you have this 12.5% as a target. Or if you've got 12.5% and you say, actually, I've been doing this some time, it's easy, do a bit more, put some more away. Because what you're doing is you're transferring money from today to tomorrow. And when tomorrow comes, I assure you, you will be grateful and thankful to yourself that you did it. I'm yet to come across someone who's retired and said, I've got too much money. I've just got too much money. I don't need this. I wish I hadn't saved so much. I don't need as much money now. Because what it does, it gives you choices. Money gives you choices in retirement, and it also gives you security. And what you tend to find is in your earlier years of retirement, one of those choices is, actually, I'm not enjoying my work as much as I used to do. I'm now going to retire earlier. And even if that's a year or two, a year can be a long time doing something you don't enjoy. Or it could be a case of doing more in the earlier parts of your retirement. So say, for example, you might decide to cruise a little bit more or holiday a little bit more. Okay, or take a prolonged holiday as opposed to just the general 2-week holiday. It gives you choice of options. It might even give you choices options to take your family away on holiday and treat your children who are going through possibly what you're going through now, struggling to get by and making ends meet. Or it might help you contribute to your community, whether that's just to your local housing area or your friends and family, or whether it's your church or your social clubs, that kind of thing. So contribution to others makes us feel rewarded, makes us feel happy, and that gives you choices then. So by putting more money away and becoming wealthier isn't a selfish thing. It's something that you can enjoy yourself, so you can holiday more, do more of the things you enjoy doing, or you can then contribute to your family and your wider community and church. So it's really important that you consider putting as much money away as you can and take action on that. First point of call is to go into your workplace pension, add additional funds into that. If for whatever reason your employer doesn't allow that, then just get online and sort your own pension out and top it up. Lexo.co.uk is a pension scheme that we've set up using the portfolios we offer through Lexington, but you don't have to go there. Just any pension. This isn't a plug for Lexo, although it's a fantastic arrangement. It's something I use with my own clients. Just make sure you put some money away for your future. It's essential, folks. It really is. Now, I want to spend a second and just speak about the self-employed market, because the workplace pension arrangements do not affect the self-employed market, which I think is terrible. And you'll find also there's a lot of limited companies, owner-managed limited companies, so director self-run the companies, that it's not affecting either, because they get an opt-out. They can sort of relinquish their liabilities towards auto enrollment. Guys, you really, really should be in at least the same position as an employee. So I do business coaching, and when I do business coaching for clients, one of the first things I do is work out for the business owner what their hourly rate is. And we look at their turnover, and they typically will divide that into the hours they work, and they say, oh, this is my hourly rate. But guys, your turnover as a self-employed individual is not your income. That's your turnover. Your turnover has to pay things like VAT, if you're registered for VAT, pay for your overheads of running your business, your stock, any wages that you might pay out, any other costs of running your business, and then what's left over, some of which can be attributed to you as a employee of that business. Okay, so if you're a sole trader, what's left over, you have no staff, what's left over could be attributed to. Bear in mind, you might have to make provision for future costs as well. Now, when we look at what's left over, quite often that's a much smaller slice of the pie. We really then need to look at the number of hours that you're working. And the living wage, I believe, is around about £10–11 an hour, depending on the number, which sort of source you look at. So are you earning the minimum wage, the living wage? Should I say not the minimum wage, the living wage? Some people aren't. They're putting the hours in. They're not earning the minimum wage, the living wage. Now that might be a case of you're in a growth period during your business, so it's just taking off, and you're putting the hours in for an investment for a future reward in the future, a future reward in the future, a reward in the future. But if you're more established, you really should ensure that your business is running profitably. In addition to that, you really must ensure that you're paying yourself into a pension scheme, putting money aside for your retirement, because there's not be any workplace pension there for you. And that comes back to paying, let's say, 9% of what your net profit is, what's being attributed to you, what your income is. So if you're a self-employed individual, that would be your net profit. That's at the bottom of the balance sheet, profit and loss statement, sorry. If you're a owner, director of a limited company, that would be your salary and dividend remuneration, so whatever that is, so literally 9% of that. I would say those figures really should be, as a minimum, you should be looking at around about £175 a month if you're basing it on the living wage. Okay, so the living wage basically is 40-hour week. You should be contributing in about £175 a month if you're going to do the 9%. That's the auto enrollment minimum. But ideally, you're going to be doing the 12.5%. So you really should be targeting nearer £243 a month. So they're your two minimums that I want you to sort of keep in mind. If you are doing nothing at the moment and you're kind of struggling, really your first point of call is the 175. Okay, so that's really the minimum. If you're contributing a bit in the moment, but not quite that, but you could do a bit more, then start aiming towards the 240. Hey, why don't we just round it up? Why don't we just say 200 and 250? Keep figures nice and round. So 200 and 250. So if you're not doing anything at the moment, let's start as a starting point, £200 a month into your pension scheme. If you're doing some kind of pension at the moment, but you could do a bit more, let's start aiming towards the 250. Now, they're just sort of figures I'm giving you just so you can have something to take away. That doesn't mean that's going to build up a pension fund that's going to be enough for your retirement. So this is where you need to do a bit of calculation. It's something that I'll cover at a future date. Actually, how much money do I need to fund today to ensure I've got enough money to retire on? But today's episode was all about the workplace pension. Hopefully I've clarified that to you, that there are a couple of different ways that your employer can offer a pension arrangement. They might have an existing scheme in place, or they might have put a new scheme in place just for you. There are three different categories of employee, that depending on how much you earn in your age, where you will fall. It means that the first category will automatically be enrolled. The second category need to ask to be enrolled and will get a contribution as well. And the third category will need to ask to be enrolled, but your employer doesn't actually have to contribute. And then there's a big shout out for the younger individuals going into the workplace. Make sure you go into your employer and ask to join the scheme, irrespective of your age and your earnings. The worst that can happen is you will pay in and they won't contribute. So it's very important you start young. Thanks very much today. My name is Warren Shute. This has been Financial Education for the Nation. Please ensure you subscribe to my channel by clicking the button below and leave me a testimonial. It just allows other people to be able to find us a lot easier. Any questions, anything you'd like me to cover in future, please give me a big shout. Thanks very much. Until next time.